Welcome along to the Finwell Daily Brief. Today is June 6th, 2025, and we're here to really unpack the key financial happenings in the Indian market. We're working from today's closing market data, various news reports, and some expert analysis that's landed with us.
That's right. Think of this as your essential download for the day. We're cutting through all the noise to get you the important stuff.
And to get us started, here's a fascinating financial fact from the sources for today. India's 10-year benchmark bond yield. It just hit its lowest point since way back in 2022.
That's a big signal right there.
Again.
Tells you straight away something major was going on today. And our job really is to look at the documents we have, figure out why things like bond yields move so dramatically, what else shifted, and what you really need to know about it all.
Exactly. We'll guide you through it, pointing out the interesting bits and, importantly, any warnings that came up. Okay, let's set the scene then. Today's market snapshot, June 6th, closing numbers. Overall, quite a positive day for Indian stocks.
Definitely look that way.
The Nifty 50, it finished comfortably over 25,000. The final number was 25,003.15, which is up 1.02%.
Solid gain. And mid-caps kept pace, too.
They did. Nifty Midcap 150 gained 0.98%, closing at 21,686.45. Small caps were a little behind, but still green.
Okay.
Yeah, the Nifty Small Cap 250 was up 0.65% at 17,285.75. So it all adds up to a decent day for the broader market. The Nifty Total Market Index gained 0.96%.
Right. And connecting back to that fact you kicked off with the bond market, saw that huge move. That 10-year yield plunging from 6.21% yesterday down to 6.15% today.
Right.
Yeah, lower yields like that definitely grab your attention. And we also saw things happening with the rupee.
We did. The Indian rupee actually strengthened against the U.S. dollar, closed at 85.64. It apparently had some weak moments during the day, but recovered strongly.
And the analysis suggests the RBI might have stepped in.
Yes, the reports point towards RBI intervention helping prop it up. Okay, so let's piece this together. Stocks rally, bond yields dive to multi-year lows, the rupee strengthens despite some pressure. These things aren't happening in isolation, are they?
No, not at all.
The sources seem pretty clear. There's one central theme, one big driver behind all this today. What was it?
Well, all the analysis we've seen points directly at a major policy decision coming out of the Reserve Bank of India today.
The RBI announcement. This was the one everyone was waiting for, and it sounds like they didn't just meet expectations, they delivered a bit of a surprise.
A big surprise, actually. The RBI announced a 50 basis points cut to the repo rate. That brings it down to 5.50%.
50 basis points. Wow.
Yeah, and the sources are highlighting just how significant that is. It's the steepest single rate cut the RBI has made in 5 years.
5 years. That really underlines the scale of this move. What reason did they give? Why such an aggressive cut now?
Well, the rationale, judging by the governor's comments mentioned in the reports, is clearly about prioritizing growth. They're making this move at a time when inflation, the CPI, is relatively tame at 3.8%. Yeah. So the RBI seems quite confident they can keep inflation near their 4% target, and they're using this monetary lever to try and stimulate the economy, make credit cheaper.
So just to make sure I'm following the analysis here, this surprise 50 basis point cut is basically the main trigger for the stock market rally, the drop in bond yields, and even the rupee strengthening. How does one action cause all that?
It's fascinating how it ripples through, isn't it?
Right.
So when the RBI cuts the repo rate, that's the rate banks borrow from them. It generally means banks can then lower their own lending rates.
Right.
For the stock market, cheaper money makes it easier for companies to borrow, maybe for expansion projects, whatever.
It also makes stocks look, relatively speaking, more attractive compared to just parking cash in bonds or deposits.
So optimism goes up, money flows into equities. Makes sense.
Precisely. Drives that rally we saw. Okay, got it for stocks. But the bond yields dropping, how does that work?
Well, with bonds, especially government bonds, they pay a fixed interest. When overall interest rates in the economy fall, those fixed payments on older, higher-yielding bonds suddenly look better. So the price of those older bonds might go up. But importantly, any new bonds being issued will now offer lower yields, reflecting the new lower rate environment. So the overall market yield drops. It's a direct consequence.
Okay. And the rupee strengthening, that feels slightly counterintuitive. Sometimes lower rates make a currency less attractive for foreign yield seekers.
That's often the textbook case, yes. Lower rates can, in theory, lead to capital flowing out if investors chase higher returns elsewhere. But here, the sources suggest a couple of things were likely at play. First, the market seems to have interpreted this big cut as really positive for India's growth outlook.
So optimism overrides the yield aspect.
Potentially, yes. That optimism about future economic activity and profits can attract foreign money into equities, supporting the rupee. And second, as we mentioned, the report suggests the RBI was actively intervening in the currency market.
Direct support.
Exactly. So you had the pro-growth story plus central bank action likely outweighing that traditional pressure from lower rates.
That connects the dots nicely, thanks. So with cheaper credit now flowing, who are the big winners in the stock market today, according to the analysis?
Well, the most direct beneficiaries are usually the banks. Lower borrowing costs for them, better liquidity, and it really helps their bottom line. And that's exactly what the sources flagged. The Nifty Bank Index actually surged to a record high today, closed up 1.5%.
A record high. That really says something. Any specific banks stand out?
Yep, the reports mentioned big names like HDFC Bank, which jumped 3.1%, and Axis Bank up 2.8%. They were clearly leading that charge.
Makes sense. And it's not just the banks directly, right? Cheaper credit helps other sectors too, those sensitive to interest rates.
Absolutely. Think about sectors where big purchases often involve loans or where development needs funding. Realty stocks did very well, up 2.1% as a sector. The sources also mentioned positive vibes and outlooks for autos and infrastructure. Cheaper loans make cars more affordable, and big infra projects easier to finance.
Right. So the RBI's move definitely set a positive domestic tone, especially for those rate-sensitive areas. But, markets are global. Things happening elsewhere must have played a role, too.
Always. And there was a notable one from the U.S. today involving Tesla.
Oh, what happened there?
Well, the sources reported Tesla's stock took a pretty big hit, tumbled about 14%.
14%? Why?
The context given in the reports points to rising friction, apparently, between Elon Musk and Donald Trump.
Wow. Politics hitting a tech giant stock that hard. Did that turbulence affect us here in India?
It certainly created ripples. The sources note Tesla's fall put pressure on NASDAQ futures, which kind of sets the tone for U.S. tech. Now, Indian IT stocks didn't crash like Tesla, but they felt some drag. Big names like TCS and Infosys, they ended the day pretty much flat.
So not a huge direct hit, but a reminder of how linked everything is. News travels fast.
Exactly. Shows you how sentiment can shift globally, even impacting stocks that seem quite removed from the original story.
Okay. What about other assets? Gold, for instance. Did that move much?
Gold actually saw a bit of a rebound today. The data shows it climbed 0.43%, reaching 99,670 per 10 grams.
Interesting. Why the climb?
Well, the analysis points to ongoing demand for it as a safe haven, which is notable because usually a stronger rupee, like we saw today, makes imported gold cheaper in local currency terms.
So the safe haven buying must have been pretty strong to overcome that.
Seems that way. The sources also mentioned continued demand from rural areas, possibly linked to festival buying like Akshaya Tritiya still having some effect. On the future side, MCX gold futures were trading a bit lower, around 97,018.
Got it. Now let's talk about the money flow. Who was actually buying and selling in the Indian markets today, especially after that RBI news hit?
Right. The flow data is always interesting.
Yeah.
Foreign portfolio investors, the FPIs, they were net buyers in equities today. Pumped in for action 400 crore.
Okay. Positive on stocks.
But, and this is the interesting part, there were net sellers in the debt market, pulled out 800 crore from bonds.
Buying stocks, selling bonds. What about domestic players?
Domestic institutions, the DIIs, they were also buying equities. Net purchase of 1,100 crore.
So that split we see with the FPIs buying equities, selling debt that fits perfectly with the rate cut story we discussed, doesn't it?
It lines up exactly. The analysis clearly links this to the lower interest rates. Debt just becomes less attractive when yields fall. So FPIs seem to have shifted capital out of bonds and into equities, likely betting on the growth prospects, getting a boost from that cheaper credit. It's a pretty classic behavior following monetary easing.
That really clarifies how different investors reacted.
Yeah.
Now, switching focus a bit, the sources didn't just cover the big picture, they also zoomed in on some specific warnings for investors. There was quite a detailed flag raised about an SME IPO closing today.
Yes, this was highlighted quite strongly. It was for a company called Ganga Bath Fittings Ltd. An SME IPO subscription closed today, June 6th. Price band was 46 to 49, aiming for about 32.65 crore.
Okay, sounds fairly standard for an SME issue, but the analysis listed some pretty clear red flags. This sounds like crucial info for anyone looking at IPOs, particularly smaller ones. Let's break these down.
Absolutely critical. First red flag, valuation. The sources pointed out the asking price to earnings, or PE ratio, was 25 times.
Okay, it's come that high.
Well, compared to the industry average for similar SMEs, which the sources noted as around 18 times. So yes, 25x looks significantly overvalued. You're basically being asked to pay a hefty premium for its earnings compared to its peers.
Right, paying more than maybe the fundamentals justify. What was flag number 2?
A heavy debt burden. This was quite striking. Apparently 55%, over half of the money raised from this IPO, was earmarked just to repay existing debt.
Wow, 55% for debt repayment.
Exactly. And on top of that, their debt-to-equity ratio last financial year, FY24, was already high at 1.8 times. Using that much fresh capital just to pay off old loans when you're already quite leveraged. It suggests financial strain, not really funding future growth.
Yeah, that doesn't sound like expansion capital. What else?
Customer concentration. Another major risk identified. The sources stated that a huge chunk, 60% of their revenue, comes from just 3 clients.
Only 3 clients make up 60%. That's risky.
Hugely risky. If even one of those clients cuts back orders or takes their business elsewhere, it could hammer Gingabat-fitting sales almost instantly.
Very vulnerable. Okay, high valuation, debt issues, dependence on a few customers. Any other red flags?
One more key one. Lack of anchor investor participation. These are the big institutional investors who often come in before the IPO opens to the public. Their participation is usually seen as a vote of confidence.
And they were interested here.
Apparently not. The sources mentioned that despite what was described as aggressive marketing, no anchor investors came on board. Their absence is often seen as a negative signal, suggesting the smart money also saw too many risks.
So putting it all together, overvalued, high debt going to repayments, reliant on just 3 customers, and no institutional backing. The analysis didn't mince words on the final verdict, did it?
Not at all. It was very direct. The sources labeled this IPO a high-risk play in a commoditized sector, and the advice for retail investors was unambiguous. Steer clear.
Steer clear. Okay.
And, this detailed breakdown isn't just about this one company. It's a really valuable case study in what investors should look for when assessing these smaller, often riskier SME IPOs. Understanding these red flags, valuation, debt use, customer base, anchor interest, can help you avoid potential pitfalls.
That's a really vital takeaway, applying that critical lens to other opportunities. Okay, stepping back to the broader market. What was the overall outlook based on today's events and the analysis? Where should investors perhaps focus their attention now?
Well, the outlook synthesized from the sources really echoes the themes we hit on. There's an expectation that those rate-sensitive sectors, realty, autos, infrastructure, will likely continue to benefit from the lower rate environment created by the RBI. But there's a clear warning attached. Be careful with over-leveraged mid-caps. Cheaper credit helps, but it doesn't magically fix a company that's already drowning in debt.
Right. Lower rates aren't a cure-all for weak balance sheets.
Exactly. And those global risks we mentioned, like the U.S. political situation potentially affecting FPI flows, they haven't gone away. Because of that uncertainty hanging in the background, the analysis suggests looking at defensive sectors, pharma, FMCG, as they might offer more stability if global markets get choppy.
Okay, so maybe have some defensives ready in case of turbulence.
Right. But there's a strong counterweight to that global caution, which is the domestic liquidity picture. The consistent inflow from SIPs, systematic investment plans, the sources estimate this is bringing in something like 20,500 crore every month. That's a huge cushion of domestic buying power supporting the market. It acts as a buffer against potential FPI outflows, maybe driven by global worries or upcoming U.S. economic data.
That steady domestic flow is definitely a powerful force. So considering everything, the RBI boost, global jitters, that domestic cushion, what's the recommended approach for investors coming out of the analysis?
The core message from the source material is really about prioritizing quality. Focus on solid, large-cap stocks, companies with strong fundamentals and balance sheets. They mentioned examples like HDFC Bank and Reliance. And, linking back directly to our earlier discussion, the advice is to steer well clear of speculative SME IPOs, especially those showing the kinds of red flags we discussed with Ganga bath fittings. It's about being selective, focusing on robustness.
Quality over chasing speculative gains. Seems like sound advice. Now, just before we wrap up, there was one more critical warning in the sources. This one goes beyond stock picking. It's about protecting yourself from, well, outright scams.
Yes, this is incredibly important for everyone to be aware of. Advance fee fraud.
Okay, what is that exactly?
The analysis describes it well. It typically starts with an unsolicited message, an email, a text, a call, offering something too good to be true. Maybe a huge inheritance from a relative you never knew, or a massive lottery win you never entered.
Sounds tempting, but there's a catch.
Always a catch. To claim this amazing windfall, you're told you first need to pay an upfront fee. They'll call it taxes or processing charges or legal fees, something plausible sounding.
And if you send the money,
Poof. They vanish, the scammers disappear, the promised millions never materialize, and your upfront payment is gone, lost forever.
nasty stuff. What are the warning signs, the red flags for this specific type of scam?
The sources list the key giveaways. First, it's unsolicited. You didn't initiate contact. Second, there's often high pressure creating urgency. You must act now, so you don't have time to think or check. Third, they usually ask for payment in ways that are hard to trace or reverse, like cryptocurrency, gift cards, or wire transfers to personal accounts.
Okay, unsolicited, urgency, unusual payment methods, and the absolute #1 piece of advice if you encounter anything remotely like this.
Verify everything independently. If an offer seems suspicious or just too good to be true, it almost certainly is. Specifically for anything financial in India, if you're unsure about an entity or an offer, the essential step, highlighted in the sources, is to use SEBI's Scores portal. That's the official platform to check if a company is registered and to lodge complaints. Vigilance is absolutely your best defense.
Excellent, crucial advice. Thanks for highlighting that. So we've covered a huge amount today, from the RBI's big policy shift driving the markets to the ripples from global events and right down to specific warnings about IPOs and scams.
Yeah, it really paints a picture of how the big macroeconomic forces, like central bank actions, interact with global sentiment and specific company or investor risks. Hopefully, pulling all this information together helps you navigate it all a bit better.
Absolutely. And as you think about today's financial story, this market rally fueled by the RBI and strong domestic buying, but set against those global uncertainties and very specific warnings, here's a question to ponder. How does this tension, this push-pull between growth opportunities and the need for caution, influence your own approach to the market right now?
Definitely something worth reflecting on. And for more insights like this daily, please do subscribe to the Finwell Daily Brief on your preferred podcast platform. And if you'd like to connect with SOS Finwell for expert guidance based on today's analysis, you can easily find us on LinkedIn.
And we'll leave you with a thought on patience and perspective, a quote that appeared in our source material today attributed to Charlie Munger. The big money is not in the buying or selling, but in the waiting.
Wise words. Until our next brief, stay well-informed and financially vigilant.
And just the important disclaimer. This brief is based entirely on the source materials provided to us for June 6, 2025. It's purely for informational purposes. It is absolutely not financial advice. Please always consult with a qualified financial advisor before